are you to tell me what to do? I don't give a damn if you say you disapprove. I'm gonna make my move, I'm gonna make it soon. And I'll do it cause it's what I wanna fucking do. Cause all these opinions and all these positions, they come in millions, they blocking your vision. But no, you can't listen, that shit is all fiction cause you hold the power.
Hi there. How come almost every so-called investor I have ever met ask me what to buy, when to sell, when to buy? It's the same questions all over again. Please give me the quick fix. Please help me do the choices for me. I really hate it. It seems there's a terrible trend that people are always trying to sort of timing the market or just not putting in the work. It feels like people are too impatient and don't want to plan ahead, at least not more than a month. I get these questions almost every day, and my answer is always the same. 1. What is your timeline for investing? Is it 1, 3, 5, 10 years? Or are you a real long-term investor? In my opinion, everything below 10 years is not real investing. And the statistics back that up. Question number 2. What is your expected return over that time period? Your compound annual growth? I would say you should expect at least 10% compound annual growth. Me myself, I want 15. Remember this point, we need to use it later. Question 3. What is your risk level? How much risk can you stomach? How much risk can you handle? This is both volatility and can you see your portfolio lose 50% without panicking?
Everybody panic!
First, when you have these factors lined up and you're confident, this is your strategy. And ask yourself, do you want to make money or is it a hobby for you? That is very important. Do you want to make money or do you want a hobby?
Agree to agree.
When you determine this, then you can start forming a plan to reach your goal within the time frame you set. The rest, well, everybody and their grandmother is panicking when the markets take a tumble, and they keep looking for reasons to why this happens. At the moment, it's Trump that gets the blame, which could be fair.
No. No. No.
No, no, 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 no. No, no, no.
No, no, no.
No, 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 no.
But please remember, the stock market requires both a seller and a buyer. Do you think I can predict the market? Do you think anyone can predict the market? Let's start with the hard facts. No one can predict the stock market, and even if there were someone who could, you would never be able to find them. If there ever was one that could, well, not predict the market but use the market swings, that would be Jim Simmons. May he rest in peace. He spent his whole life to master it, and we don't have or don't want to spend all our waking hours researching trading algorithms and stuff. So, there are 2 consequences of this truth. As you can't time the market, you should stop trying to figure out the market, because it's a waste of time. We probably should fire all the stock experts who fill the airwaves with stock market predictions. It is not news that the stock market is unpredictable. This has been proven through several major studies. In one of the more colorful experiments, the Wall Street Journal attempted to test a hypothesis that Professor Burton Malkiel claimed in his bestseller A Random Walk Down Wall Street. He wrote, "A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts." The Wall Street Journal had their employees act as monkeys by throwing darts at random stocks, and the so-called monkeys won 40% of the time against professional stock speculators, who were otherwise well equipped with suspenders, computers, and a lot of nonsense. Ladies and gentlemen, a monkey throwing darts can beat the pros 40% of the time? Huh. So the first insight is that every time you see 10 stock experts making predictions about the future in the stock market, 4 of them have hair on their toes and are making their forecast with a banana in one hand and a dart in the other. A diplomatic suggestion here would be, take their recommendation with a grain of salt. They might not be correct. The grotesque truth about stock predictions alone should shut down the massive coverage of the stock market in the news, because there truly isn't anyone who knows what they're talking about. And remember, they're all incentivized to get people to buy or sell. This is how they make their money. And we have yet to mention that the portfolio managers eat away at your investment every day, whereas a dart set only requires a one-time payment at Toys R Us. But it turns out that you don't need either an expert or a dart set to make a correct decision with your investments. Let's take a closer look at that claim. But first, a quick disclaimer. If your hobby is to follow companies, read annual reports, and you get a kick out of the excitement of buying and selling stock, then this video is not for you. You just need to know that this hobby, like all hobbies, will cost you money. However, if you invest rationally to optimize your return on investment over a longer period, 10 plus years, then this video is for you, because there's a right and a wrong way to do it. To get closer to understanding this, we first need to go through a fundamental difference in investing. It's active versus passive investing. Active investing is based on the assumption that you think you can beat the market or that you can find someone who can. Typically a portfolio manager. It's an expensive solution because you pay the manager's salary, and if you do it yourself, the risk is very high that you will also lose money on some of your decisions. That brings us to passive investing. This is based on the assumption that you don't believe you can beat the market, and therefore you typically choose an index, usually using an ETF. It works by allowing you to buy a small piece of many stocks, thereby following the general development of the market. So instead of spending your hard-earned dollars on mutual funds that has hand-picked specific stocks where the portfolio manager believes he can beat the market, instead you use the cash on an ETF that simply follows an entire stock market or an index, like the S&P 500 or the Nasdaq, or even better, a combination of these, maybe even more for extra security and diversification. Here you could watch my video on the best portfolio ever. Wait. Watch it when you have hit the like button and watch this video to the end. For example, if you buy the S&P 500, you will get a return that matches the average performance of this index. No more, no less. Statistically, the simple index will give you a better return over a longer period by doing absolutely nothing and simply following the general development of the market. Here are 3 examples of studies that support this, and these are just a few. Number 1. 2% of American portfolio managers can cover their cost with extra gains. Finance professors Kenneth French and Eugene Fama found in 2010 that only 2% out of 3,156 American portfolio managers had statistically valid skills and could cover the cost of their own fees. French and Fama wrote about this in the article Luck versus Skill in the Cross-Section of Mutual Fund Returns. This was published in the Journal of Finance. So there is actually hard data to prove the point. Active managers are not worth the money. 2. Index funds outperform active investments over time. A portfolio with low-cost index funds will statistically perform as well as the top 3% of active managed funds, and better than the remaining 97%. Remember the Warren Buffett $1 million bet with hedge fund managers? Well, Warren Buffett bet he could outperform any portfolio manager's picks using only the S&P 500 over a 10-year period. As the bet started in 2008, Buffett wasn't up to a great start as the 08-09 crash occurred and the hedge funds did what they do absolutely best. They hedged. Buffett's index lost around 37% and the hedge funds only lost 24%. It took 4 years for Buffett's index to catch up to the hedge funds again. But in 2015, Buffett's S&P 500 index was lagging gains with a measly 1.4% gain, versus the best hedge fund, which had 1.7% gain. But here comes 2017. The S&P 500 comes back with a vengeance. Buffett had almost 10% gains versus the hedge fund's 1%. When we reached December 2017, the last competitor gave up, and he lost with a measly 2.2% compound annual growth. Warren Buffett's index, the S&P 500, had a 7.1% compound annual growth. In money terms, this meant Buffett had gained $854,000 and the hedge fund had gained $220,000. So no, most portfolio managers can't beat the index, at least not over a prolonged period. Over 83% of active funds cannot even match the benchmark. This was reported by the Financial Times, which present this and other striking figures and concludes, "These seriously disappointing records would not be at all acceptable if produced by any other industry." Let's just reiterate that. Active managed funds could not even match their benchmark. In my line of work, that would mean you're fired. And just to put another nail in the active investing coffin, if you still think active investing will help you earn more money, you must have considered what economists call opportunity costs. That is, what you could have done with your time instead. For example, if you spend 5 hours a week reading about investments, buying and selling stocks, talking to your investment advisor, etc., etc. 5 hours a week. You could, for example, have delivered newspapers instead. Here you could earn a bit over $12 an hour, which adds up to a monthly salary of around $250. If you choose to deliver newspapers for those hours instead of spending time on research, then with compound interest and an annual return of 7% in an index fund, you would have had extra $285,000 in 30 years. So, your active investment strategy must therefore not only beat the market, which it likely does not, but it must also beat the market by over $285,000 over 30 years. Otherwise, you have wasted your time. Your time could have been spent better, making more money. There is principally only one method to beat the market. The method involves finding out something about a company that no one else in the market knows, such as they are about to land a big order or something like that. If you have this information, you can make a lot of money. For example, in his excellent book, The Signal and the Noise, Nate Silver cites a study showing that politicians in Congress and Senate are strangely good at picking stocks. Wonder why? Their portfolios systematically outperform all others, both indexes and actively managed stock pickers. What skill do these people possess? For instance, Financial Times estimates, very conservatively many would say, that the number of professionals engaged in stock speculation has exploded from about 5,000 people to over 1 million now. The turnover on the New York Stock Exchange has in the same period increased by 500 times in volume. In other words, it is impossible to find the informational advantage that is ultimately the only way to beat the market. So, it is a special form of delusion if we believe that we can sit at home on our sofa, in our comfy pants, and predict anything about the development of a stock or an index. But how do we explain a man like Warren Buffett then? Well, before we attempt that explanation, we should remember, the American star investor's favorite investment advice is, you guessed it, invest in an index, which covers the segment you believe in. But hey, why don't more people choose index funds if it's so obvious? Well, there are 3 main reasons why more people don't choose indexing. It's boring.
Boring.
There is absolutely no excitement. Index funds pay off for all the boring reasons. There's high diversity, minimal turnover, and low expenses. There are no flamboyant CEOs, no annual reports to watch, no news, nothing that gets you on the edge of your seat, no secrets, nothing you can be the first to discover. It's a bad business for the others. Since index funds are very cheap, no one really makes money from you, and therefore it is not an attractive solution to market to you. This means we are carpet bombed with all sorts of reasons to choose active investing and stock picking. We are all being biased to believe we can beat the market. Biases are systematic errors we make when making decisions because we follow certain thinking patterns. One of the worst biases that prevent us from making sensible decisions is overconfidence bias, which I will make a video on soon. This overconfidence, combined with the human tendency to connect the dots in random data, will, with post-rationalizing narratives, means we go in the wrong direction. We think we are the 1%, but the problem here is, so do the other 99%. Maybe you should watch my video on confirmation bias as the third next video.
What did we learn, Palmer?
In the end, passive investing in index funds is the only right choice if you have a time horizon longer than next Monday.
Life moves pretty fast. You don't stop and look around once in a while, you could miss it.
There is no reason to try to be smart, as Warren Buffett's lifelong investment partner Charlie Munger has formulated it. It is remarkable how much long-term advantage we have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. So, if you want to make money with a high probability, choose passive investing. If you want to likely lose money relative to the passive investment option, but you like the experience of excitement along the way, choose active investing. Or you could break out the darts and start throwing them. On that note, I'll end the video. Please give it a like if you did. And remember, the very best investment you can do is in you. The more you learn, the more you will earn. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the night inning. There ain't no point in resisting.